Hello, everyone, and welcome to today's interview with Cash Allred. Today's our first interview for the podcast. We've been interviewing founders and equity experts in recent months, and now we have a podcast. So that's exciting. These interviews and the podcast are for early stage founders, their teams, and investors. It's all about helping create value from equity. We're going to deep dive into these topics, but not all the jargon and complexity. We're going to try and give you answers, actionable insights, best practices, unpack some great stories, and we're going to try and have a bit of fun. So we are talking about financial and legal matters today, but this is all general and our own opinions. No advice here for those people that want to get a bit weird about it. So welcome, Cash. I'm so glad to have you here. We've worked together before, and he has some awesome insights into the VC space. And today's topic is ways that retail investors can get investment exposure to startup equity. It's really not cool that investing in startups is mostly only for the wealthy. I did a little bit of research coming in, Cash. It sort of baffles me a bit why we have these rules. So returns on the stock market, maybe 7-8% per annum. Property is about the same. But my research on, Harvard Business Review and Investopedia shows, 11 to 25% per annum returns in sort of VC and private equity. So certainly love to dig into this and see how we can get retail investors better access and just try and unpack, how this whole thing works,
Yeah, of course. I think it's definitely a conversation that's a hot topic right now. We're seeing access to various asset classes opening up across the board, not just in startups and venture capital, but a lot of the history here is built on the 1940s Investment Act and SEC rules that date back to that time. The SEC, or Securities Exchange Commission, was facing a dilemma where how do they protect widows and orphans as we're coming out of a hard economic period from being scammed and being sold securities that are worthless in
Yeah.
whatever investment class that is. And
Yeah,
so
it is unfortunately a part of the industry where scammers will come in and trick people into giving them their money. And of course, we want to mitigate that risk as much as we possibly can, but it needs to have some sort of middle ground or some balancing out of this space, because there's so much opportunity and people want to get involved. They want to back innovation, entrepreneurship. They want to see the space sort of powering forward. So yeah, I'm glad to see that things are opening up.
yeah, it's true. And if there's some frameworks around what the SEC feels is important to protect those people who may not have all the information they need to make an informed decision. And the SEC essentially has drawn a line where they say, okay, to sell securities, you have to register them with us and you have to report a certain amount of information before you can market or sell these securities. And that's essentially the principle behind the way the SEC thinks and operates. And what that's done in startups is it's meant that because these companies are private, they're not publicly traded on exchange, they're not doing public reporting, it's been really difficult for retail investors to get access in the past. But that's starting to change.
Because it sort of seems like a good idea, right? Hey, this is risky. We should make sure you're disclosing enough information. Let's put some regulations around that. Like, it seems kind of logical, but my understanding is the cost is the problem. The problem is the cost. The cost to provide that information for a startup, on an ongoing basis and tick all the boxes legally is super prohibitive. Is that sort of generally a bit of an issue?
Yeah, there's a couple things. One is these laws were enacted when information was very scarce, when it was all paper and word of mouth. It was very difficult to truly verify a lot of information.
You go out
Today,
into the town square and you say, hear ye, I have some equity on offer.
exactly,
In the
like
1940s, crazy.
yeah, you can read stories and newspaper clippings of like salesmen going door to door selling investment into bridges, like to connect Long Island to other parts of the country, and it's wild to think that that's the way it operated. But today, a lot of these regulations don't make as much sense as they did, and that's why people are asking questions. They're saying, if I can if I can do all this research on a public company and buy stock there, I can do this research on a property that's next door to me, or there's so much information even about the startups themselves that they can get comfortable with.
Yeah.
Why not let them make that choice?
Exactly.
But
So the core of capitalism, we need capital to go where it needs to go. We need people to be able to put their capital where it needs to go, but we do need to have some protections in place because, bad stuff happens and it can be people's life savings. So let's dig into ways that people can, as a retail investor. Well, let's first of all clarify what that is. So there's retail and accredited. Are they the two main terms that we need to understand here?
yeah, you could say accredited or unaccredited. Sometimes we say retail investors to represent that independent
Same thing.
person, individual that's like making a choice by themselves. So retail is more of a loose term, but accredited investor is, and I'll back up again to this framework of the SEC says, to sell securities, you need to meet certain reporting requirements and register those shares with certain governing bodies, whether it's the federal SEC or state governments. And there are exceptions to that. So over time, there have been carve outs where they say, okay, for this asset class or this fund structure, you don't have to register those securities with the SEC, or you don't have to do the same kind of reporting. You can keep some of this information private, but you can only work with accredited investors.
Yeah. Okay.
And this is actually where venture capital was
Because
born. It's operated under this Reg D exemption. So
Okay, so the Reg D exemption is the exemption of information that you have to share to investors, but you can only do that with an accredited investor because they're supposedly sophisticated enough to be able to do the research themselves.
exactly. So and it's they still have to disclose information to their investors,
Yeah.
but they don't have to share that information with the SEC to the
Okay.
same degree. So if I'm a Reg D fund, a venture capital fund, I'm not registering shares of my fund with the SEC and reporting to the government, all these things. I just have a responsibility, fiduciary responsibility to my investors. That's
Yep.
those rules are still in place, but it's less burdensome to report and to manage that way. So
Okay.
now to the accredited investor piece, you're like,
Oh yeah.
this is the rule that the SEC says, okay, they're educated or whatever, but the rule that they have is
Am I allowed to point out here that I know accredited investors that are potentially not sophisticated enough to do this work, or is that a bit cheeky?
well, the SEC has essentially said if you're already rich, you're accredited,
Exactly.
and so they're
Not
using
sure about that.
income. Yeah, they're using income as a proxy for sophistication,
Yeah,
which is an insult to everyone who's
it is.
trying to make it there, that is, made themselves sophisticated. Um, and to your, jab, it doesn't necessarily mean that they're sophisticated. And so there are ways you can take classes and get certifications to become an accredited investor without reaching
Okay,
those requirements. But
that's cool.
those tests are often so broad with information that's so general just about investment structures in general,
Okay.
that if you want to invest in startups, going and getting those certifications is a huge pain, and you have to learn a ton of stuff that has nothing to do with investing in startups. So
Mm,
I found that very, very, very few take that
gotcha.
test.
Gotcha.
They typically, the default is, do you have this amount of income or not?
Yeah.
Or do
And
you
what's
work
the
in an
income level?
industry?
So it's assets and income is the pretty simple way to look at it. Like a certain amount of
Yeah.
assets, certain amount of income.
Um, so it's different for families and individuals. If you have a gross income of 200K or more in the two most recent years, then you're an accredited investor. And I think it's like
Okay.
300,000. There's also like
For
just
family.
total net worth numbers. Yeah, for a family. And there's total net worth numbers too that I could go and dig up.
It's okay.
But
It's
given
okay.
that,
So let's dig into retail investing now, or unaccredited investing. So what can you do if you don't satisfy this income level, the asset level? If you haven't gone and done this course, how can you get involved in investing in startups and back these companies that you want, help change the world? Potentially access some of these outsized returns that we've seen from VC and private equity, or maybe more so like early stage, not VC necessarily, but early stage startups.
sure. I've seen three ways. One is through employee stock option pools. That's where you're probably more of the expert than I am, Jason, with Cake. Uh, so you go and you work for a startup and they pay you in equity in addition to your salary. The second is there's been recent changes in the last decade or so around regulation crowdfunding, which is a separate exemption for individual startup companies to sell shares of their fund. And the third are registered funds. And that's actually something that Sweater's pioneering, and we can talk more about later. But there's some trade-offs between each of those three. And
yeah, let's dig into quickly. Let's dig into crowdfunding, just so we're providing a broad idea for people. Obviously, love what Sweater's doing, and we'll chat about that in a minute. So, crowdfunding, it is sort of what it says. You're going out to the crowd. The startup works with a crowdfunding platform, and then is able to bring in investment from the crowd. Are you able to share some insights into that space?
Yeah, so the startup has their job in order to raise money from unaccredited investors is to register those shares with the SEC and to provide all of the information per that exemption and report it publicly so that those retail investors can make an informed decision. Well, it turns out it's super complex and challenging, especially for early stage companies.
And so like
these platforms, right? And that's why the platforms exist, right? They're trying to grease the wheels of saying, hey, we're going to help you know what to report, what you have to share, what you don't. You can work with our trained lawyer. We have some accounting partners that can verify your financials. There's this whole thing that has to be done.
I guess the worst case scenario for the startup is they say the wrong thing, and then somebody invests, and you probably get in quite a bit of trouble for that. So I think that's another part of that service that the platforms provide, and just helping the startups to make sure they're disclosing the right information, and which is a cool service.
Yeah, and those platforms, like, they provide a lot of value because this is so new, and because there's a lot of work involved, and the founder doesn't want to be an expert in regulation crowdfunding. They want to be an expert in building their company. So they lean on these platforms to do that. The challenge is now you have to pay for all of that. And so I've seen that some of these startups raising on crowdfunding platforms, they have to pay a certain percent for the platform fee. They have to pay for the accountant verified financials. They have to pay for the lawyers to get their docs together. Then they have to pay the filing fee. And then on top of that, they have to pay an extra 10 or 15% of their raise to market the securities.
Whoa.
And so by the time it's said and done, they're spending, let's say they raise $500,000, they're spending 10 to 18% of it.
Whoa.
Before
really?
By the time
I didn't realize it was so high.
It is super expensive.
That's wild.
And a lot of
I'm
the
gonna go into
expenses in the marketing.
No, I'm kidding.
Well, and not all of it goes to the platform, right? A lot of it is cost for the platform, or just the marketing of the securities. And I don't know if I mentioned this earlier, but the SEC is they're sticklers about what you can and can't do to sell a security.
Yeah.
And so regulation crowdfunding is an exemption that says, hey, you can go market these now because you've given a certain amount of reporting, but now you have to pay for it. You have to pay the social ads or whatever else to get it in front of enough people.
I guess even though there's cost and time, I presume there's a lot of time and effort goes into making all those documents and working with the accountants and the lawyers and doing all the marketing. Capital raising is super hard in the first few years. We all know that, until you really start to get the company pumping, and then sort of the dynamic changes a little bit back in favor of the company. But people still really love it, right? Crowdfunding is really popular. Big platforms are what? Start Engine, WeFunder. What else have we got? Republic. And there's
Seed
a few
Invest.
There's a bunch out there, and they're raising good amounts of capital, I think. Is there a limit on the amount you can raise? I think there's a limit, but it might have increased recently.
That's right. So and I'm not a crowdfunding expert to that degree. So I mean, you can just people listening can Google this to verify. But regulation crowdfunding, I believe it's
ChatGPT for it. Maybe it'll make your whole crowdfunding plan for you now.
Totally. I think RedCF is something like 2 million a year, or at least that's the old one. It was 2 million. Now they've upped it to 5 million in a 12-month period.
Well, that's pretty cool. You can do more than that. If you're going to go to all that work, maybe now the percentage of your raise can come down because you can raise a bit more with similar amount of effort. So that's kind of cool.
Well, I've seen that some of these are charging 1%. So I don't know if the percentages
Gotcha.
change that much, even as you
Gotcha.
grow, but some of
Well,
it does, I'm sure, like the
definitely look for
accounting and
definitely look for fee for service providers if you can.
totally, totally.
Cool, cool,
But
cool. Let's do a quick rapid fire, a little bit of some technical term stuff. Let's get off crowdfunding. That's definitely an avenue for retail investors to get involved, and for people to raise, startups to raise. We've touched on accredited investor. We've touched on Reg D. What about Reg CF, Reg A plus? Are they worthwhile? Just sharing a little bit of info with the crew.
Reg CF is the exemption that allows for equity crowdfunding.
That's the crowdfunding one.
And
Got it. Yep.
yep, and then Reg A plus is also a form of regulation crowdfunding. But it is higher reporting requirements, but you can raise up to higher amounts.
Okay.
So if you're only raising sub 5 million, Reg CF is easier. Reg A plus, similar process but more stringent. Often the platforms do both. So
Okay.
just
And
a trade-off between those two vehicles.
and unaccredited investors can invest in all those things?
In Reg CF or Reg A.
Okay. Okay. Nice. All right. So look, let's get on to Sweater. I don't know when we met. It was like last year. Love what you guys are doing. We're big believers in community here at Cake, innovation, entrepreneurship. Like, I think that this is how we're gonna change the world. So it's been wonderful to get to know you guys. Tell us a bit about your story and how you ended up at Sweater Cash.
Sure. So I've been at a few venture funds and private equity funds so far in my career. Most recently, prior to Sweater, I spent 3 years at an impact fund. At that fund, we pivoted from a traditional fund structure to deploying philanthropic capital out of donor advised funds. And this is where my brain started to open up to, okay, if we can get access of capital from different sources, that creates some pretty unique strategic advantages that we can leverage on how we choose companies to invest in and how we support them. And at that impact fund, we actually started to build software around managing relationships with our donors and putting the right opportunities in front of them so that we could be very strategic in what we wanted to accomplish. So later, when I met Jesse and he was getting Sweater off the ground, it immediately clicked for me. Here's a fund that is seeking to raise money from everyday people instead of being limited to Reg D, which caps you to 99 investors a fund. You can only work with accredited investors or institutions.
Yeah.
This is raising money from
So they're
thousands of
looking
everyday
for,
people.
regular VCs looking for 100, 150K checks at a time, right? Or more. So it's so exclusive. I just love, how you've been able to really open it up. Like, how many investors have you got in the Sweater fund now?
So I joined 2 years ago. It took about a year for us to get the tech in place and to get the fund through the process we needed to allow unaccredited investors to participate. And we launched in June. So up and running for less than a year, and we have 5,500 investors so far.
Awesome. That's so cool. Is anyone else doing this, or are you guys pretty unique? It seems quite unique. I can't recall bumping into anyone else doing it yet.
Yeah, and this is related to back to the SEC conversation. The SEC is okay with um, uh, unaccredited investors having exposure to startups and private companies. Sweater's just the first one to go through the pain and suffering necessary to register the fund with the SEC. So we actually report to the SEC as publicly registered fund, and we register those shares so that our retail investors can buy into it.
Love that.
And
That's so cool. Well done. So innovative.
yeah, and it's been great. The reason why maybe nobody else is doing this is because traditional VCs they don't want to deal with the headache of thousands of investors. If they could have 5 investors to raise their $100 million fund, they would do it. But the other reason is that
Let's dig
Sweater
into
doesn't
that
charge
though.
carry,
Oh, you don't charge carry?
not in the same way that a traditional VC would. So traditional VC is charging a management fee annually, but then they also charge carried interest on the back end as the companies are selling.
Yeah.
Sweater actually charges fees this very similarly to what a brokerage account would, or if someone has money in a mutual fund, how that would operate, where because we're pricing the assets in the fund every day and we're reporting that to the SEC,
Ah,
we're just charging an annual fee on the value of the portfolio. So if we invest 100 million, but then 2 years later or 4 years later, it's double that, we're charging the annual management fee on that.
on the new price. Oh yeah,
Exactly, exactly.
cool.
Whereas a traditional VC fund is doing it on committed capital and then carried interest. So
Got
it's
you.
easier for our retail investors to understand.
It is.
But a traditional VC is not going to give up their carried interest
No, right, right,
to
right.
do what we do.
Well, let's dig into the why. Like, why would you go to all this effort? You know, why would you give up the carry? I mean, it's a lot of work, and but like it seems like it's having a huge impact. So let's dig into that.
Well, the founders of Sweater, and I believe this too, we feel that it is insane that there are hundreds of thousands of people that work at venture-backed startups. There are thousands of entrepreneurs that are pitching VCs and know what VC is, and like a very, very small percentage of them have any money in a VC fund.
Yeah.
And like regulation crowdfunding has democratized angel investing to a degree. Like you can buy shares in an individual startup through regulation crowdfunding, but
Yep.
that's not venture capital. Venture
No.
capital is putting your money into a fund
It's
and
really
having a
hard to
fund
do that.
manager.
You got to look at every
Yeah,
deal. You got to try and diversify yourself. I mean, it's a lot of work, and most people between work and family, they don't have time to sit around. I mean, of course, it's cool if it's a hobby or whatever, but like, getting access to a VC is a totally different beast because, you've got people like yourself and your team going out and doing all that hard work to pick companies and create diversification. So yeah, it's an awesome opportunity.
and you want your money not just in the companies that choose to register their securities on a crowdfunding platform.
Totally.
You want to be in startups that do that and don't, right? And
Totally.
so there's that selection bias. And I'm not saying that those who raise equity crowdfunding are worse companies. I'm just saying that there are fewer companies.
Absolutely.
And you don't, and that's just something to keep in mind.
And the choice
Uh
has been taken away from you because you're just on that platform. You only get that platform's opportunity. So I think that's cool. And I want to dig into something you just said there about bias. So, we believe there's a lot of strength in the community. And I know we talked a bit about diversity before, and it's diversity of opportunity, and it's diversity, opportunity of the right companies to get access to and the right companies to back. So share a little bit of, I guess, about how the crowd adds value to the Sweater offering.
yeah, we kind of one of our taglines here is that venture capital has the power to shape the future, which it does, but the right to shape the future belongs to everyone. And so by allowing thousands of investors to invest in the Sweater Cashmere Fund, when we invest in a startup, we can turn around and talk to them and tell the story of what they're doing to this massive community of investors, plus 50,000 other people that are on our mailing lists. And when we do that, it provides a ton of value for these seed and Series A companies. Uh, that alone in itself, just like putting a pre-built community on their cap table, but they interact with us the same way they would any other VC,
Yeah.
is a
Like,
powerful story to them.
Cake has a big cap table. We've been community led all the way, and our angels are so valuable for us. They champion us. They listen to our updates. They go out. They do introductions. Like the crowd is incredibly powerful for building brand and loyalty and sort of that's like critical in today's business environment, isn't it?
It's true, and I think it resonates. Just even the ethos plus the practical piece of that resonates with the entrepreneurs. The other thing is, as an industry, there's a lot of criticism about a lot of the venture dollars going to white men in the US.
I would support that.
It's like there's
it's,
and
it's not
a lot
cool.
of it is practical problems. And so let's just break down those incentives for a second. You have a GP, let's say that the GP is a white man who has raised money from a few dozen, not a ton, of accredited or institutional investors that are often white men. And so if I'm a GP and one of my investors brings an opportunity to me, so GP is the VC that's actually making the investment decision. LPs are the investors, just for people listening. But if the GP has an LP bring to them an investment opportunity that's a friend of theirs, they actually feel like they have to come up with a reason to say no. Rather, that's their
Yeah.
default, because they don't want their LP to be upset with them. So they
Yeah.
have to keep their LPs happy. And what this creates is a dynamic where it's friends helping friends, and they all look the same. They went to the same schools. They're in the same circles. And despite what we do in measuring and pushing VCs to be more equitable, there's back of their mind incentives and biases that will
Yeah.
push them towards people they already know.
They're strong
Compare that to
biases.
Sweater.
It's hard to work against those things no matter how much you try.
Exactly. And then you compare that to a model like Sweater where, maybe I'm a white male.
Yeah,
Yes,
me
I'm
too,
making
just in
some of these
case
investment
no one
decisions.
noticed.
Yeah, but our investors are thousands of everyday people. None of them, well, maybe I met a few of them, but most of them I've never met.
Yeah.
And they're bringing their friends to the table. We have a scout program of over 100 scouts. A lot of them are invested in the Kashmir Fund, and they're naturally bringing a huge set of diverse founders from across the country.
Yeah.
And we're seeing that. We're seeing naturally our deal flow is incredibly diverse, lots
Yeah.
of women founders in our portfolio. And it's happening naturally because the fund structure fits what the American public looks
Love
like.
it. And you're
Um,
uncovering problems that otherwise probably not getting uncovered. So I think if you're trying to find opportunities as an investor and invest in opportunities, as an unaccredited investor through the Kashmir Fund, you're going to be getting access to problems that probably not getting seen by traditional VCs. And I think that's an incredible opportunity for investors as well. Super
Yeah,
cool.
I think the access to the opportunities is important and just discovering them. But then the other thing is I'm not incentivized to keep one LP and their friends happy
Yeah.
as much as a traditional VC fund is. And so that frees us to be clear-minded and making those good investment decisions no matter where these people come from.
Love it. Love it. Love it. Amazing. Congratulations. Innovative, solving problems, breaking down barriers. So yeah, super keen to keep partnering with you guys. Look, that's been awesome. I think we're pretty much out of time. Let's finish on a high. So the creative, healthy lifestyle section. We love this at Cake. Our Cakesters use their health as a platform to live their best lives, and it's core to our culture. And how does this resonate with you, Cash? And what can you share from your perspective on how health helps to drive creativity, mental health, things like that at Sweater?
I don't know how many VCs can say this, but I grew up on a farm in the middle of nowhere, Mountain West, United States. And so like a lot of my hobbies are more like work focused. I love house projects. I drive a 1965 Ford pickup that I restored
Cool.
as a teenager, and I tinker with that. Um, my wife and we will have our third kid next week, and I'm fairly
Congrats.
young to have, 3 kids, but I love just, have a healthy lifestyle of getting out with my kids, doing projects with them. We go home to the farm every year and do projects there. And I just think that um, feeling connected to where you're from and your family is a big part of that. Whether you go fishing, whether you go hunting, whether you go skiing, I've done all those things and love them all. And uh, I think that that's super important.
That's really incredible, mate. Yeah, connection to family. What a wonderful place to grow a great life and a great business from. Look, let's leave it there. Everyone, that was Cash from Sweater, a good friend of ours at Cake. We're so grateful to have you on to share your insights and help unpack retail investing or unaccredited investing. And I think there's been plenty in that for everyone. So thanks, Cash. Thanks everyone for joining. And yeah, we'll see you soon.